It's the week ahead at xm.com. Thanks for joining us, and a very busy week lies ahead. I'm Cristina Marujos, and help me unpack the week's events is our senior market analyst, Rafi Boyadjian. Rafi, the OPEC Plus alliance is holding a meeting over the weekend, and it's anticipated to hike output for August. What could that potentially mean for oil prices when markets open on Monday?
Yes, indeed, Christina, we're getting yet another OPEC meeting because, of course, now they hold one every month. And we are expecting another increase in production of 411,000 barrels per day. And this was basically the figure that we got in May, June and July. So this is the likely scenario. However, there has been some talk that they might opt for an even bigger increase in output. And this is the main risk for oil futures on Monday, because if we get a bigger than expected increase, that could potentially weigh on oil prices, because of course, we've seen oil prices pretty much erase the gains they made on the back of the Israel-Iran conflict, and they've been under pressure all year due to the trade war, concerns about slowing US economy. Although having said that, even if we start off negatively, potentially maybe should we get some positive trade headlines, as we're expecting some trade deals in the coming days, that might potentially help oil prices recover.
Now let's turn to the central bank front. The Reserve Bank of Australia meets on Tuesday with markets expecting a 25 basis points rate cut. How might the Aussie react?
So I think we're not probably going to see a huge reaction. I think it's pretty much baked in that we're going to get a 25 basis point rate cut. I guess the bigger question here is how many rate cuts are we going to get after that? Markets are penciling in about one rate cut at every other meeting for the rest of the year. Should the RBA signal a steeper rate cut, not directly, but more likely, should they do that by sounding more worried about the growth risks, particularly with the ongoing trade war? Although having said that, we do have this trade truce between the US and China. And of course, China being Australia's main export market, everything that happens there pretty much affects Australian policy. So there is a risk that the RBA might sound a little bit more concerned, put more emphasis at least on the growth risks as opposed to the inflation risk, in which case that might weigh on the Aussie. But I think on the whole, we're probably not going to get many surprises.
And now looking at its antibody cousin, the kiwi has had the chance to gain on the back of a weaker dollar recently. How might the Reserve Bank of New Zealand policy meeting on Wednesday affect the New Zealand dollar?
So I think that this time around, of course, the RBNZ had been pretty busy over the last year making significant rate cuts. Now they're getting to a point where they're probably going to go on pause, and that's what we are expecting from the RBNZ on Wednesday. There is still, though, a 20% chance that we might get a 25 basis point rate cut. Because the jobs market in New Zealand remains pretty weak. Even though we got a decent rebound in GDP in the first quarter, we're still yet to see that effect on the labor market. Having said that, inflation has ticked up a little bit, so this is probably going to make RBNZ policymakers a little bit more cautious going forward. So the question is, how strongly are they going to signal a pause? Are they going to say we're on pause for the foreseeable future, or even though we're not shutting the door to a rate cut, we're going to, that's going to be quite some time away, the need to potentially cut rates again? Or are they going to say we remain quite worried about the economy and the trade war risks, so we might cut again in the near future? If that turns out to be the case, the kiwi might come under pressure, but I think if, as expected, the RBNZ signals at least for the next few meetings they're going to be on pause, I think that's probably going to help the kiwi recover further against the US dollar.
I see. Now, speaking of the dollar, and of course, let's cross into the United States. Fed Chair Powell recently left the door open to a July rate cut, although he reiterated that the committee remains data dependent regarding further monetary policy action. So what do you think the Fed minutes, which are out this week, could reveal on that?
So it was indeed very interesting, the Powell's remarks over the past week. I think nobody was expecting him to basically signal the possibility of a July rate cut, but he did so probably out of concern that we might have gotten a weak jobs report on Friday, which on Thursday rather, because of course it came out early due to the Independence Day holiday, and that jobs report was stronger than expected. So now there's not really much urgency for the Fed to cut in July. Of course, we've still got the next CPI report on the way before the next FOMC meeting, but I don't think, unless we get a huge decline in CPI inflation, I don't think there's much chance that we're going to get a rate cut from the Fed in July. However, the minutes are going to be important because we might see some signals of divisions, of a split within the FOMC, because of course we already heard from two governors putting their support for a July cut. We need to see if, how strong those divisions are within the FOMC. Potentially that's something that could worry markets and potentially weigh on the dollar. However, there's also a chance that we might get a somewhat more hawkish than expected sort of comments within the minutes, in which case that might help the dollar gain ground.
And finally, Rafi, will be getting data releases from Canada and the United Kingdom. What should FX traders keep an eye on in those data sets?
Indeed. So although it's going to be pretty quiet in the US in terms of economic data, we're going to get some key releases elsewhere, notably in Canada and the UK. So in Canada, all the focus is going to be not so much on the data, but whether or not we're going to get a trade deal between the US and Canada, because of course we've got the reciprocal tariffs deadline coming up on July the 9th. And this is significant for the Bank of Canada because they're in a pretty tough spot at the moment. The inflation, underlying inflation at least, has been picking up a little bit, while we're seeing some weakness in the economy. And should we get a trade deal announcement in the coming days, then I think the Bank of Canada is going to be more confident about staying on hold going forward, in which case the employment report might not have a huge bearing on the Canadian dollar. However, should there still not be any trade deal, which, it's not necessarily going to panic the markets, because with Canada the deadline is later in July, but of course there is hope that they might sign one in the coming days. I think should we get a weak jobs report out of Canada, that's going to pretty much keep the door wide open to a rate cut from the BOC at the end of July, because of course jobs market has been in the doldrums in recent months. And the good news here is that underlying inflation, which had been a concern, did come down a little bit in May. So this does make it easier for the Bank of Canada to cut rates should it need to. So I think, a lot is riding, of course, what's going to happen with trade announcements. But in the absence of one, I think a weak report would weigh on the Loonie. Now looking at the UK. The UK has been in focus for all the wrong reasons again, because of course we had some jitters in the bond market, in the UK bond market, specifically when it comes to concerns about the UK budget deficit, because the Labour government had been hoping to make significant welfare reductions to save the government some money, but they had to backtrack on that because of course there was a huge rebellion within the Labour Party. Now this has basically renewed concerns within the markets about the sustainability of the UK debt. We saw UK gilt yields rise a little bit, and the pound come down quite heavily, in fact, against the US dollar. Now, with the GDP data that's due on Friday, should we get some upbeat numbers there, I think investors might, be a little bit less worried about UK budget, because of course stronger growth helps the government, take in more revenue. So we might see some benefits to the pound from stronger than expected data, but on the whole, I think the data is not going to be a game changer, and And I think on the whole in the markets, when we're looking next week, it's all going to be what we're going to get with the trade deal announcements, which countries are going to sign a deal, which countries are potentially going to get an extension, and which countries are going to get potentially letters from President Trump warning them that unless they sign a trade deal, they're facing higher tariffs. So I think a lot is riding on that.
I think we'll have a lot to look forward to in the upcoming week. You're absolutely right, Rafi. Thanks so much for joining me. This was The Week Ahead at XM.com.